Hello, everybody, and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett, and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm, IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often, I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Hi, Charles. Listen, thanks again for taking the time today to go through what now is becoming an interesting series of calls that we're doing, talking about sort of the rationale behind the sell side, but also the rationale behind the buy side. And we just recently did a call on the fact that you sold Home Depot out of the portfolio, and that was great. And anybody who wants to listen to that call can just go and find the Home Depot call. But now, the question comes up, okay, well, what are you going to buy now? And you've now gone ahead and made a recent purchase in the portfolio to a new company, and we're taking a look on the screen here, and the company's UPS. So I'm really interested to find out, what the rationale is behind buying UPS. Obviously another one of the leaders or greatest companies in that particular space. Everybody knows UPS, so why now? Why buy it now? So maybe I'll just pass it over to you, and you can give me sort of a bit of an update on why you're buying UPS today.
Okay, thanks, Scott. Here we are. We did a sell not too long ago, and here we are with a buy. And as we know, and as we keep talking about all the time, is we're looking for predictable, really good businesses that people understand or you can really understand, and we're looking for a price that the market is mispricing it. So when we look at United Parcel, everybody knows them. I mean, they deliver 16 million pieces of parcels every day worldwide. And we've seen that the market's gone up a little bit over the last little while. And to try and find more and more value in the space, doing the evaluations, I've looked at UPS, and UPS is trading at a point that the market price now is at $88.15. We bought it a couple of days ago at around $86. And what the market is saying when we do the valuation, like the flip side of when we do the evaluation on the sell side, is that the market is saying that at $87, $88, UPS will permanently lose money. And the reason is that the stock is trading under the cash that they're already making. In other words, when we look at if we take the cash of the business over the last 12 months, the real cash that was generated, not accounting cash, but real cash, and we look at what that cash has been, and we value that at 1, for example, that means that the amount of cash it generated is equal to the market price, so that's 1. What we did is we bought it at $86, and the market is assuming that there's going to be a permanent loss of 16% or 15% in the market trading under the cash that's already generated. So in other words, the market is saying, well, it generated cash, but it will permanently lose money, which has attracted us.
Interesting. So what's been happening in that space that has been kind of beating up the packaging, or what is the space called here?
Well, it's not even I guess global slowdown. It's hard to understand. People can say, well, this is what the market's expecting. Why is the market expecting that? And it's very difficult. No one knows why the market is doing anything, which is why our process sticks to what is actually happening versus what we think is happening. But that aside, global slowdown, problems in Europe, China rolling over. There's all kinds of interest rates going up. There's Amazon, competition to Amazon, where people think that maybe the delivery companies over time we're going to be delivering less. Whatever the reason may be, it shows up from an evaluative point of view, which is what we like.
So do you have any of those metrics that we can take a look at?
Well, right. I can just say that it's at $88 now. It also has almost a 3% yield.
Oh, okay.
So your guess is as good as mine on why the market would expect a predictable business never to make money.
Right.
And the same is why does the market, when we had our last sell call on Home Depot, why does the market think that it's worth twice as much as it actually is based on the history of the company? So that's my job. That's our job here, is to try and look at what the market is mispricing. Then when it is mispriced, in our opinion, we look at it and say, well, what's behind it? How can we beat up the company? How can we wreck the company? How can we blow it up? What if the market is right? What is the market expecting? And when we look at it, we see we do not agree with that.
Yeah,
we buy it, and that's the process. That's the process that we have. So if we look at this page, we do go down, and one of the big things that we look at is price to economic book value, and that again is basically a cash number, not an accounting book value, which would have inventory and all that. This has nothing to do with that. This is basically a cash number.
Okay.
So what the market is saying now, if the company was worth 1, if the company matched its cash in the last 12 months, then the economic book value would be 1.
Okay.
But it's 0.1, it's 0.8. So what the market is saying is that this dollar worth of stock is trading at 80 cents. So the market is saying that there's going to be a permanent loss of 20 cents. $1 minus the 80 is 20 cents.
Right. Yeah. So I can.
So the company's going to have a permanent loss of 20 cents. Well, what we do is when we do the deep dive, the economic book value is based on a real scrubbed cash number, not anything else, not an evaluation. It's a non-growth cash number. So the same as we did with all the other companies that we buy and the companies we'll buy in the future, we're looking for something that's mispriced. Even though the return on invested capital of the company, you see over to the left a little bit, is 23%.
Right. So the company is actually growing has been growing at a rate of 23%. And correct me if I'm wrong, growing at a rate of 23%. But for when you value the company at $1 and it's currently priced at 80 cents, you're in essence buying those dollar bills for 80 cents with the knowledge that it's been returning a 23% growth rate, or it's been growing by 23% for, I don't know what time period it's referring to. What time period would that be referring to?
Well, we're looking at 1, 3, and 5-year returns there.
Right. Okay.
But you're right. What we're trying to do is we're trying to get dollars under $1 that we're buying that are actually cash. So when you look at the free cash flow yield there in the middle, that's between 3 and 10%. So free cash flow is the amount of money. First of all, when we look at the numbers, they're all scrubbed as we've spoken before. Scrubbed at their real cash return on real invested capital. That's 80, 90 pages of footnotes that we have to reconcile with the economics of the business. So when we look at these numbers, these are scrubbed actually business numbers. They're not accounting numbers. So we look at the 3 to 10%. So the free cash flow yield is everything left over after all bills, pension plan, everything paid for, that is available to do what we want with.
Okay.
So here again, what we're doing is we're looking at the market, in our opinion, mispricing a good company.
Yeah, I mean, it's very clear obviously the summary you're showing here, there's a lot of information, a lot of research that goes into putting this summary together. But from a layman's standpoint, you've got a company that's growing at 23%, that's got free cash flow of 3 to 10%, and it's trading at 20% below its economic book value. So basically, which
is basically the cash value, and that's a non-growth cash value over the 12 months.
Right. So the market's saying this company's not going to grow. It's going to by what it's pricing it at, but we're saying but that doesn't make any sense because it's been growing and it's got a lot of free cash flow. So it's obviously mispriced.
Exactly. Now, when we have the sale call on this, when we have the sell side on this, now we have the buy I bought yesterday. Then eventually we're going to have a sell call on this. And then I'm going to say, here's what happened. We bought it at $86, and now when we're looking at the economic book value, it could be 1.8, 1.9, 2, twice as much. Then we look at the valuation. We're saying the market is expecting it to grow 2 times faster than it has historically,
right? Yeah.
Over 10 or 15 years to make up with the valuation. So, this is our first call. Then we're going to have the sell call. So if we put the first call and the sell call together,
that's called investing. Yeah, making
right.
profit.
That's called investing, and we don't want to have a conversation necessarily about why the macro aspect or why the market thinks that way.
Yeah, because really we don't care what the market is thinking. The reality is that you've identified the metrics which are telling us this is a mispriced great company. That's
right, and where we don't care what the market says, but what we do care about is putting the probability factor on the metrics being predictable.
Mm-hmm.
That's why we don't buy techs or don't buy resources. Look at Mosaic; it dropped 35% in one day.
Yeah. No, I know, and
what we want to do is we want to make sure that the businesses that we're looking at are not going to be disrupted tomorrow or have a really outside impact on it, which is why we're very protective in the kinds of businesses that we like.
Yeah, and we've done a call. If anybody who's listening to this wants to hear sort of about the filtering process that you go through to determine is this company even worth investing in, as a solid company, then they can listen to one of the previous calls that you go into really good detail as to why you buy what you do and why you don't buy certain things that just don't make sense from an investment standpoint. And you've said it before.
Right, and you'd be hard-pressed for somebody to make the argument that UPS is going to blow up.
Right. Yeah.
Certainly in the future. So UPS is a company you can look at, study the history, do a deep dive, understand how the business works, how they're expanding. I mean, they shipped over 221 countries. Yeah. This is a major company. Now, it might not be a major company 10 years from now. It doesn't matter, because if things start showing up in the profitability of the company, I'm going to notice that quickly.
Mm-hmm, mm-hmm. Yeah, well, that's great. Well, listen.
So the company's as good as what the numbers are. And if the numbers start coming in, I'm going to see if that free cash flow goes negative. I'm going to understand why that's happening.
Yeah. And so you've got your dashboard, so to speak, that allows you to very quickly pick up on trends that are potentially moving the company into a direction that might make it either ripe for a buy or ripe for a sell.
I know what UPS is doing every day.
Yeah, absolutely.
So it's one of the 20 companies, so it's on, it's like having 20 kids. Okay, you got to make sure that you know where all the kids are.
Yeah, absolutely.
Even if you don't like it, you want to.
Well,
so
super.
You know everything about the kids.
Yeah, well, that's great. Well, I appreciate you taking the time just to sort of to go through that and to give people who are currently investing in your portfolio some rationale as to why all of a sudden now they're seeing UPS show up in the portfolio, and this gives a really good, clear indication as to listen. The math is telling us that it's a mispriced great company, and it's the time to buy. So I appreciate you taking the time just to go through and explain all that to us. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter. Twitter.com/IronShieldCFP. Like us on Facebook, Facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.